Hello, we're already into the second quarter of this year. Typically, you're supposed to start a quarter feeling full of energy, maybe full of optimism as well. I don't quite feel like that. I'm looking forward to a week off next week. The first quarter has been intense. It's been busy, full of events. I would say full of events in markets, but the markets actually have been very well behaved. On average, equities up about 4%. Everybody focusing on the US and Europe. While emerging markets have sort of snuck up and outperformed, or rather performed by close to 10, 11%. And bond markets, again, have been generally quite well behaved. Bond yields, if I look at the US Treasury, keeping within a pretty tight range. Corporate credits and investment grade doing pretty well too. So what's ahead of us into the second quarter? Well, I think the first lesson we've learned from the last 3 months is that what happens in the newspapers, what happens in the real world, doesn't automatically translate into markets. Every day, it seems the newspapers are full of talk about politics, either in the US, the elections in France. We have political events in Russia, in Turkey, in South Africa, and also in parts of Asia. And they are interesting. I think in many respects, politics has become more interesting than fiction. But as an investor, it doesn't really carry across to markets in a very broad sense. I think the thing that markets are really fed off in the first quarter is the business cycle and the upturn, not just in optimism. We see that coming through in a lot of the soft leading indicators, the surveys, as well as some of the hard data. And there's a sense, I think, now that the business cycle is really the driver. The US, I think, is now in the expansion phase. Europe is just behind in what I would call the recovery phase. And broadly, I think, as well, emerging markets as well into that recovery phase. And this will probably continue for the next couple of quarters. I think one thing that's important is that the pace at which much of the macro data is beating expectations will probably slow because the bar has been set very high. So we would expect that you will see probably balanced performance between defensive sectors relative to cyclicals. Again, I think that means that for parts of the bond market, like the treasury market, the trading range becomes quite narrow, maybe from 2.3% where we are now up to about 2.7%, depending on how the inflation data begins to materialize. I think the debate in the US around the Fed is now actually also very well marshaled. Other people will point out that there are a number of key political events coming up. Everyone, I think, is fixated on the French elections. We have the first round on the 23rd of April, and then the second final round on the 7th of May. If you haven't seen it, my team has just put out a very detailed 51-page presentation on the French elections with all of our scenarios, all of our investment views, and also where we interrogate the electoral promises of the main candidates. To some degree, I think people are maybe guilty of focusing too much on the French elections. I think if it goes, if there is an extreme result, it will upset markets. We'll see more volatility. But again, I would point out that there are political events and political undercurrents happening across the rest of Europe and other parts of the world. One thing I take from the second debate, which had 11 candidates, so we had some of the less well-known candidates, and many of those, I think, are to the extremes, probably more to the extreme left than the extreme right. And I think they do underscore a sense amongst ordinary French people that they are dissatisfied with maybe how France as an economy is going. And perhaps, if we believe what some of their political candidates say, how Europe is going as well. So again, this underscores some of the things we have seen in Brexit, also in the US elections, and that, I think, is something to watch for, not just now, but also beyond the election itself. In terms of investment strategy, again, we focus on the business cycle. We're overweight Europe within our equity portfolios. We've recently upgraded Canada to overweight as well. Again, energy and commodities being part of the story. Our underweight in Japan is working out very well. It's down 4 or 5% relative to the bigger markets. Within fixed income, we're now neutral government bonds overall. Our overweight on gilts in the UK has done very well. We've taken profits in that and moved that back to neutral. Staying with the UK, we think the pound will rally through this quarter. It's cheap, it's under-owned. A lot, if not all of the Brexit bad news is now in the price. And also we're overweight REITs, or real estate investment trusts, in the UK as well. And then finally, at an asset class point of view, perhaps our two favourite asset classes are real estate, or REITs, where we are overweight, and commodities with a focus on energy. Energy and energy equities have been underperformers in the first quarter, and we would expect that to reverse as we go through the second quarter, as supply begins to tighten and demand picks up. Thanks very much.